Now, let's understand the approaches which are typically used by market participants whenever they are to actually figure out what should be the cost of debt capital, cost of equity capital, and cost of preferred stock as well. So remember the K terms which are there everywhere. We have the KD, we have the KE, and we have the KP. So the next two, three slides are going to talk about how this calculation works. Now, the cost of debt is the rate at which the firm can issue new debt capital whenever it is trying to raise additional capital for itself for its projects. Now, we know the idea of tax shield, which I have discussed earlier. So that's why the after-tax cost of debt is nothing but the interest rate or the yield at which the debt can be issued, the new debt can be issued, minus the tax savings, which you show by this formula, which takes us to this formula for after-tax cost of debt. And as I mentioned earlier, there could be very few jurisdictions globally whereby you don't get this kind of a tax benefit or tax shield. So that's why you adjust the T, as I've explained it below as well. So now one might want to figure out how do you decide how much should be the cost of debt. So two popular approaches which are used by industry participants for such a purpose is what we call as a YTM approach. So as many of you must have guessed, YTM is nothing but the same yield to maturity which we study in fixed income. So we have the YTM approach and we have the matrix pricing approach. So let's understand what both of them are. So for the YTM approach, any financial analyst is going to look up the current YTM for the firm's debt. And here the assumption is the company's debt is publicly traded. So that way, all that we need to do is go to a market source, maybe a Bloomberg or a Refinitiv or any other market data source and look up what's the YTM for the firm's debt. And this current YTM is something which will be used in calculating the cost of additional debt which the firm needs to issue. So this is the simple YTM approach, provided you have bonds which are actively traded in the market. However, it can so happen that the company's debt may not be publicly traded, or maybe the company is going for a debt raising for the very first time. So there are no publicly traded bonds on its name. So then in that case, another approach which could potentially be used is what we call as a matrix-based pricing approach. Now, we'll assume that the firm in question at the moment is carrying a rating of double A. And let's say the average maturity is 10 years. So two components, so double A and 10 years. So then we can again go to our market data source and we can look up the yield curve which is available for double A credit rating. So there could be certain data sources whereby we'll directly get a double A rated credit curve. So whereby you have the adjustments for treasuries which is already done. If not, then you need to source the treasury yield curve from one place and then we make an adjustment for a double A spread on top of it. So it could be either of those, but then we will need access to the yield curve for a triple A rated credit rating. And we use this curve as a reference, and the analyst is going to look up what is the yield which is currently being offered for a tenor of 10 years. Now, why 10 years? Because then the firm's debt rating is assumed to be double A and it has an average maturity of 10 years. So that's why we look up the 10-year tenor only. And this can be used as a proxy when we try to calculate what is the cost of additional debt capital which the firm wants to raise. So these two are common techniques which are used by analysts when they have to figure out what's the cost of debt capital. Now, one point to remember is on the earlier couple of slides, we assumed that the debt is going to be in the form of a plain vanilla bond. So when we know the definition of a plain vanilla bond, that means there is no optionality, there are no other features, etc., which are embedded. So that's what we call as plain vanilla bonds. So if it's a plain vanilla debt, those couple of approaches which I mentioned earlier, the YTM and the matrix-based pricing could be used. However, a company might go in for a non-vanilla issuance at times. And there could be different reasons or different rationales as to why a company might want to go in for a non-vanilla issuance. And typically, non-vanilla issuance could be, let's say, bonds with optionality. So let's say there could be a bond with a issuer call option or an investor put option. Or maybe the company might want to go in for a floating rate debt whereby the coupon on the bond gets adjusted periodically to the market rate. Now, if there are bonds which like these which have been issued, now as a part of this video, we'll not get into the discussion as to why a company will go in for such kind of issuances. But then, when such bonds are involved, there might be certain modifications which will need to be made to the to factor in the additional features which are there, so that then we are able to capture the proper cost of capital for this non-vanilla kind of a structure. Also, it can so happen that there might be different set of covenants which are defined as well. So typically a financial analyst will always go through the bond prospectus very, very carefully, because then the bond prospectus is going to talk about what are the covenants which are involved, or even the trustee document could have the same as well. So positive and negative covenants will have an impact, and accordingly, this is going to have an impact as to how we make an adjustment to the overall KD component, which is in turn going to impact the WACC number, and finally, all of the places whereby the WACC is going to be consumed. So this was a small note for non-vanilla bonds.